The accounting flow follows a 5-step process: source documents, journal entries, ledger accounts, trial balance, and financial statements. Today, we will be covering the ledger account process. A ledger account is more intuitive than you think. I want you to see a ledger account as, literally, an account. For example, if you have a bank account and look at your bank account statement, you will notice that the account statement will show you the starting balance, transactions occurring within the period, changes in your bank balance due to the transactions, and a brief description of the transaction. A ledger account works similar to this. Two formats of the ledger accounts are commonly used: the T account and the columnar account. The appearance varies, but the general functions are the same. The T account is used more prevalently in the past, when accounting was done using pen and paper. With the increasing usage of computer software today, most accountants have moved to using the columnar account. I will illustrate the functions of a ledger account using the columnar account, but I will also briefly share the differences between the two formats laterwards. A columnar account typically has the date, description, debit, credit, and balance columns. To illustrate how a ledger works, I will give a few hypothetical transactions. First, let's say the entity's owner contributed $100,000 into the business. Cash and capital will increase by $100,000, so we debit cash and credit capital by $100,000. If you still have difficulties with journal entries, be sure to watch the video on the double entry system. Coming back, when we debit cash by $100,000, we will write $100,000 in the debit column. Now, what do we write in the description column? I like to call the description column corresponding account sometimes, because that is what you need to key in, the corresponding account for the transaction. I debited cash by $100,000. Which account did I credit by $100,000 for this transaction? It is the capital account, right? So key in capital in the description column. I believe the balance column is quite self-explanatory. You just calculate the balance to date. Assuming the business started with no cash, when the owner deposited $100,000 into the business, the cash balance is now $100,000. Next, let's now assume the business borrowed $50,000 from the bank. The cash and bank loan balance will increase by $50,000. So the journal entry for this transaction is debit cash and credit bank loan by $50,000. So we will put $50,000 in the debit column. We debited cash by $50,000. What is the name of the account which we credited by $50,000? Refer to the journal entry. It's the bank loan account. So put bank loan in the description column. Now our cash balance will increase by $50,000. Before this transaction, the balance was $100,000. So now it will be $150,000. $100,000 plus $50,000. Third transaction, the business purchased inventories for $60,000. Payment is made upfront. What is the journal entry here? Remember, payment is made upfront, so cash will decrease. Inventories will increase because the business bought inventories. The journal entry for this transaction is debit inventories and credit cash by $60,000. Since we credited cash by $60,000, we will put $60,000 in the credit column. The account that we debited by $60,000 is inventories, so we put inventories in the description column. Let's calculate the balance. Before this transaction, the cash balance is $150,000. Now it decreased by $60,000 due to the purchase of inventory. The new balance is $90,000. Please note that for debit nature accounts, the balance figure is always in the debit column, and for credit nature accounts, the balance figure is always in the credit column. After purchasing the inventory, the business sold it to a customer for $75,000. This is a cash sales, so cash is received upfront. The goods sold were purchased at $30,000. First, the business received cash from the customer by making a sales, so cash and sales will increase. We debit cash and credit sales by $75,000. Next, inventory level will decrease because some goods were sold. When goods were sold, we will recognize an expense called cost of sales. We will debit cost of sales and credit inventory by $30,000. What is the figure to record in the cash ledger? Pay attention to the journal entry. Cash is debited by $75,000. Key that into the debit column. The account that was credited by $75,000 is sales. Key that into the description column. Now, recalculate the balance. Before this transaction, it was $90,000. Now, it has increased by $75,000. We get the latest balance of $165,000. What about the debit cost of sales and credit inventory? Will that journal entry appear in the cash ledger account? No, because that journal entry does not touch the cash account. It touches the cost of sales and inventory account. So the entry will be recorded in the cost of sales and inventory account. It will not be recorded in other accounts. Finally, let's assume the business bought an equipment for $98,000. Equipment is an asset because it helps in the day-to-day operation of the business in various ways. Cash is paid to buy this equipment, so cash decreased and equipment increased. We debit equipment and credit cash by $98,000. Key in $98,000 into the credit column of the cash account. Next, we credited cash by $98,000. Which account did we debited by $98,000? Key in the name of the account in the description column. Lastly, recalculate the balance. Original balance before the transaction is $165,000. Cash balance has decreased by $98,000 due to the purchase of equipment, so the latest balance is $67,000. Assume that in the month, only these 5 transactions touches the cash account. At each month end, we want to bring down the balance for the next month. This is straightforward. Just write balance BD, meaning brought down, balance for the month, closing balance, or any similar terms in the description column to indicate that you are closing the current month's account and showing the month-end balance. Next, copy the latest balance into the balance BD line. I hope you get the rough idea how the ledger account works. Before I end off, let me briefly show you how the T account is used. First, draw a big T on the paper. On top of the T is the account name. The left side of the T is the debit side and the right side of the T is the credit side. So let's record all 5 transactions into the cash account in the T format. In the first transaction, we debited cash and credited capital by $100,000. Write the corresponding account name, in other words, capital, and the amount, which is $100,000, on the left side of the T. Next transaction, we debited cash and credited bank loan by $50,000. Do the same as previous. Write the corresponding account name, bank loan, and the amount, $50,000, on the left side of the T. Third transaction, we debited inventory and credited cash by $60,000. This time, since cash was credited, we will key in the corresponding account name and amount on the right side of the T. Transaction 4, we debited cash and credited sales by $75,000. Key in sales followed by $75,000 on the left side. Finally, in the last transaction, we debited equipment and credited cash by $98,000. Key in equipment and $98,000 on the right side. Now, I suppose you notice an obvious difference between the columnar account and the T account. In the columnar account, the balance is actively tracked, but not for the T account. The method of bringing down the balance for a T account involves slightly more work. First, calculate the totals among the two sides. For the left side, it is $100,000 plus $50,000 plus $75,000, which is equal to $225,000. For the right side, it would be $60,000 plus $98,000, which is $158,000. Now, we notice that the totals on the left is more than the totals on the right. Take the difference between the two figures. $225,000 minus $158,000, which is equal to $67,000. On the side with a lower total, write a line item balance BD followed by the difference between the two sides. This also means I have to update the total on the right side to $225,000. In other words, you are forcing both sides to have the same total by putting the balancing figure on the side with a lower total. The balance should be the same using either of the two formats. Some of you may complain that the ledger account format looks daunting. Actually, a ledger account will not be published, so the format can be tweaked. I like to add an additional column in the columnar format called reference, where I can write a short note about the transaction. Some companies may even use a hybrid account that is a combination of both the columnar and T account. Regardless of which format you use, just make sure the essential functions are present, and I hope you note that the essential functions common in the two formats is a corresponding account column, a debit column, and a credit column.